My name is Byron James. I'm the Deputy Minister of Executive Council, and I'm a public servant. I've been a public servant for 26 years, and will be a retiree with you in good order. So, thank you for coming. If you do require, everyone will have an opportunity to speak, so please give us an opportunity to speak as well. If you require translation services, there are headsets available to my left. Part of the presentation will be in French, so those who need headsets, please take advantage of those headsets. I have with me this afternoon the Honourable Wayne Higgs, Minister of Finance. He is sitting in the middle. Conrad Ferguson, who is an actuary with Morneau Chapelle. He is a specialist who is working for the province, or with the provinces of Brunswick. Conrad lives in Fredericton and is originally from Tracadie, so he is a good Brunswicker. And Pierre Marcel Desjardins, who is a professor in economics at the University of Moncton and is a member of the task force. So that is your head table this afternoon. Our agenda will be very, very straightforward. Minister Higgs will provide some opening comments. Conrad Ferguson will provide a short presentation on the shared risk model, and then the floor will be open for questions and comments. There will be microphones available, so please take advantage of the microphones, and we will have an opportunity to hear from everyone who has a comment or question.
Thank you very much, and good afternoon. I guess as the meetings have changed, and I'm sure you've read about a few of them that were held yesterday, I find that we're closer to the door here in this one than we were in the others. I hope that's not a sign of a need for a quick getaway. Well, I hope at the end of this that there will be more information that we'll be able to discuss in a very open and transparent manner. Firstly, my apologies for this session needing to occur at this stage of the game. I think there's been a lot of information that is out there that is fueling the fears for the worst, and I'm hopeful that today, as you understand what is being proposed, you will appreciate what we're up against as a province, but more importantly, how we're planning and trying to find a way to manage a pension plan that is inevitably will be in a problem situation. Pensions around the globe are being challenged, especially in North America, but also in Europe. You've seen that. You've seen pensions have major impacts in the private sector, where the funds have not been there to continue to support them. When we talked about this very early on in our mandate about looking at reforming the pension, it was because we wanted to make sure that pensions were sustainable and that pensions would be there on a continuing basis for both retirees and current employees. And so that is the goal, is to put a model together that ensures that pensions will be there. The status quo will not support and sustain the pension plan as it now exists. The task force was proposed early on to look at the needs and balance the needs between retirees and those employees working. So that when we talk about balancing that, it's not putting everything on the backs of the current employees, it's not putting everything on the taxpayers of the province, and it's not putting everything on the current retirees. It's trying to balance a solution going forward. We have communicated to retirees, but obviously we have not been effective in doing that. And again, I apologize for that, because that is our mistake. I don't know how else to say it. If you feel I wasn't meaningful, because I sincerely am. It's obvious we didn't do it in the right manner. One thing is clear, however, it would be wrong for us to ignore the situation. It would be easier, much easier, to ignore it. But it would be wrong for us to do so. In this time, in this year, in our current third quarter, you saw an additional $53 million added to our deficit, just because of a change in the mortality tables that we were required to accept in the funding model that now exists, and in the county rules. The task force that was put in place concluded that our program, as it exists, is not sustainable, and we need to look at a way to ensure that it is, and that's what this is all about. So, with me today, and as previously introduced by Byron, Conrad Ferguson is going to go through a presentation to provide information to you, to allow you to formulate your own questions, and hopefully give you more information. This presentation will be available to you. It'll be on our website, so you can access it in its entirety. We also want to set up a better mechanism of not only communication, but better discussions about what makes sense. Because that, again, we've missed the boat there big time. So, Conrad, I would ask you, and I appreciate your patience as he presents. Everyone will have a chance to ask questions. We will set mics up in the aisles, and you'll all have a chance to ask questions when he's completed. I just ask for your patience to let him go through the full presentation. We can come back to any slide afterwards, and we can go through it in further detail or address questions, whatever works for you. But you'll have as much as you need, sir. All right. Thank you very much, Conrad.
Thank you for coming out today. My name is Conrad Ferguson. I'm a qualified fellow of the Canadian Institute of Actuaries and have served as an actuary for the province of New Brunswick's pension plans for over 20 years. I work with a firm called Warner Chappell. It's an independent consulting firm, and I'm not an employee of government, and I'm not a member of this pension plan. My job is to provide technical advice to plan sponsors like the province regarding the finances, the costs, and the operations of pension programs. The standards of the profession I belong to, the Canadian Institute of Actuaries, impose a professional obligation on me to provide objective, unbiased, and factual advice. Facts are what you'll hear from me today. I'm not here to tell you, I'm not here to sell you anything. I'm here to answer your questions and do my best to make sure that you understand the current state of the PSSA, the Public Service Superannuation Act, and the proposed shared risk plan. Before I get into the presentation, I would like to acknowledge again that there's been little direct communication with you today on the topic of shared risk plans and your pension program. All of you have heard that changes to your retirement pension were being considered, and there has not been a lot more information to you as of yet. This shared risk plan idea is completely unknown and is virtually new, is new to all of you. Understandably, this information gap has caused many of you some concerns and worry. We regret those concerns that you may have experienced as a result of this communications gap. Today is about giving you the information that you need in order to better understand the shared risk program and your current pension plan. It is our goal to provide you the best, unbiased information possible so you can determine by yourself what the situation is and what the proposal means. First of all, we've listened to commentaries and concerns over the last little while and have designed a presentation to respond to some of these concerns. Many of your questions will probably be answered through the presentation, but I'm sure there will be many others that will come after I'm done. So as mentioned previously, if you could hold your questions until I'm done, then we'll have ample time to answer your questions to the best of our ability. Alors, commençons. Vous avez probablement entendu que vos pensions seraient désindexées. Quand j'entends désindexées, ça veut dire que de quelque manière, l'indexation que vous avez reçue à date serait enlevée de votre pension. Ce n'est pas le cas. La pension que vous recevez présentement sera la pension que vous continuerez de recevoir s'il y avait une conversion au régime à risque partagé. Par contre, l'indexation future serait affectée dans un régime à risque partagé, puis je vais en parler davantage plus tard dans ma présentation. Vous avez probablement entendu dire aussi que les pensions de survivants seraient réduites. Encore là, ce n'est pas le cas. Les pensions de survivants vont continuer à être payées comme elles sont payées présentement et elles resteront les mêmes. Par contre, encore, l'indexation changerait dans un régime à risque partagé. Vous avez entendu aussi qu'il était possible qu'il y aurait des réductions importantes dans vos pensions à l'avenir à cause de l'indexation. Mais encore là, ce n'est pas vrai. Il y a des changements, évidemment. Je vais vous les expliquer dans ma présentation sur quel effet que ça aura sur votre pension si un régime comme celui-ci est adopté. Une autre inquiétude, c'est que la sécurité de la pension serait réduite parce que l'administrateur du régime ne serait plus le ministre des Finances. Encore là, la sécurité ne serait pas réduite. Un régime à risque partagé doit être enregistré sous la loi des prestations de pension, doit suivre une réglementation stricte sur la gouvernance. Et elles sont explicites dans la loi, explicites dans la réglementation, et la surintendante des pensions supervise le tout. Finalement, une autre inquiétude, c'est que votre régime serait probablement, les gens qui peuvent croire que votre régime serait le seul qui n'aurait pas d'indexation à la pleine inflation pour l'avenir dans les fonctions publiques. Au Canada, présentement, il y a 3 provinces qui ont de l'indexation conditionnelle. La Nouvelle-Écosse, qui a changé récemment, le Manitoba et la Colombie-Britannique. Ces régimes-là, l'indexation dépend de la performance de la caisse. En Alberta, l'indexation est 60% du coût de la vie. À Terre-Neuve, 60% du coût de la vie, mais seulement après l'âge de 65 ans. À Saskatchewan, il y a un régime à cotisation déterminée, donc ça ne devient pas un facteur. Puis, au Québec, la formule est complexe, mais essentiellement, pour le service depuis 1982, c'est 50% de l'inflation ou moins. Une autre inquiétude a été que les cotisations de l'employeur aient pris des congés de cotisation. Depuis 1978, dans le graphique ici, vous voyez la ligne jaune, c'est les cotisations des employés. Les barres rouges, c'est les cotisations de l'employeur. Depuis 1978, l'employeur a cotisé environ 1 milliard de plus que les employés. 1,69 $ pour chaque dollar que les employés ont cotisé. Il n'y a pas eu de congé de cotisation durant cette période. You may wonder why there's a dip here. And in this period, the plan was in a surplus. When the plan is in a surplus, the special payments that are made to pay deficits cease. That's a requirement under the Income Tax Act. And that's why they ceased. When the valuation was started again 3 years later, was done again 3 years later, the plan had a deficit. And the special payments continued. Now, to be totally, to cover the area totally, prior to 1978, the province's contribution did not necessarily match what the employees put in. There are certain periods in there where the province didn't contribute. The plan started in 1931. In 1931, there was $20,000 deposited in the plan as employee contributions. Government started to contribute in, I understand, around the mid-50s, putting a certain amount, but not necessarily matching. NB Power started in the 50s as well and matched. NB Liquor started a little later. But there is a period in there where there has been no employer contributions or not to the matching of the employees. Pour revenir à ce point-là, le régime avait atteint un surplus en l'an 2000, alors le régime était pleinement provisionné à cette date-là, mais les circonstances du marché depuis ce temps-là ont fait en sorte qu'un autre déficit s'est accumulé. On n'a pas besoin de changer maintenant. La pension est garantie maintenant. On est sécure. Le niveau de sécurité de votre pension présentement n'est pas suffisamment élevé, puis je vais toucher à ça dans mes commentaires aujourd'hui. C'est pour ça que la province va regarder à faire des changements pour améliorer la sécurité du financement de vos régimes de retraite. Une des raisons. Now I'll move over to explaining, now that I've covered certain concerns, I'll move over to explaining what a shared risk program is and how it will impact active members who are still contributing, like Byron, and you as retirees. And then I'll go through an example or a summary of what that impact might be going forward, if it were approved. intent of a proposed shared risk plan is to provide you the same indexing as you get now, if possible. So if the investment returns, yes, understood, and I'll cover that with you and what the impact is. I understand. More money is allocated to your benefit security. When we value a shared risk plan, we don't lower the retiree liability that much, and we're funding to 115% level, not the 100% level that is now. So the actual money that will be deposited in the fund to the security of your benefits and to pay for your indexing will increase of the order of $25 million a year. Because of the restructuring, there's a bigger impact on active members in this transition. Now the objectives, we live in an uncertain world. We can't predict the future. There's lots of uncertainty. And the objective of shared risk plan is to manage this future of uncertainty, to improve the security of your benefit, and I'll say more about that in my presentation, to be clear on how this uncertainty will be managed in the future, so that if results are not quite what we expected, what will happen to the benefits and the plan, and also to remove the large budget fluctuations due to economic factors that are well outside the control of the provincial government. Those are the main objectives. Now let's look at the current situation. Pension plans in the province are large. Your pension plan to public service is a plan that's measured in billions of dollars. There can be budget swings in the province because of operations of the plan that vary between plus minus 100 million in a very short period. Bond rating agencies also watch pension deficits very closely. And lastly, there's a projected budget deficit of 478 million on a budget of 8 billion. Now, just to give you some idea of the size of your plan, at April 1st, 2012, the plan had what we call going concern liabilities of 6.2 billion. That means that we make certain assumptions about the future, that the plan could earn 6.6% per year return. 6.2 billion is the amount of money that would be required today in a fund, together with that 6.6% return, to be sufficient to pay your pensions for as long as you live and as long as your survivors may live. That's the amount. The standards for calculating this are about on a 50% chance that that return will be achieved over the next 20 years. At April 1st, 2012, there was 5.2 billion in the fund. So there was a $1 billion shortfall. That's why the red bar on the previous graph were high. The government has to continue to make special payments as per the Act. Every year, the fund needs $400 million in investment income to keep pace with the needs to pay benefits. If that's not attained, then there's a deficit. If it's exceeded, it helps pay past deficits or it creates a surplus. More money is going out right now than coming in. In 2011-12, the plan paid out $270 million and collected $225 million. That shortfall is growing because there are more and more retirees and more pensions being paid. And that's you're correct. There are less workers, meaning the inflow changes too. That's a fair comment. The big one is that there are more and more retirees. Even if the workers stayed stable, you'd still have a big growth in the shortfall. Le gouvernement cotise environ 250 millions par année à partir de l'année prochaine. Pas le gouvernement, le total. Le gouvernement et ses employés, 250 millions. Le gouvernement paie $2,50 pour chaque dollar que les participants et participantes paient. There's about a 50% chance that over the next 20 years, the plan deficit will increase. There's about a 25% chance that the $1 billion deficit will be doubled 20 years from now, despite continuing to make those contributions at $250 million a year, growing with inflation and so on. Now, if you look at the issue of a guarantee, addressing this uncertainty with solid probabilities that the guarantee is there, on April 1, 2012, there would be a need to deposit another $5.5 billion in the fund. Let me explain though. That's, when you talk about guarantee, you mean that you would invest the money in highly secure investments like Government of Canada bonds at very low interest rates. If there are very low interest rates and you want to pay the same pension, you need more money in the fund. And I'm not suggesting that that's the investment strategy, but if you think in terms of a guarantee today, that's how the money should be invested and that's how much money should be there. Otherwise, there's variability in the financial markets and the guarantee depends on something else. Nothing is ever 100% guaranteed. The world is far too uncertain for that. Guarantees are always dependent on two things. The amount of money in the fund that backs up the promises, and when the funds are not high enough, there are shortfalls, additional funding from the entity that's backing up the guarantee. In the case of pension plans, guarantees are always dependent on the sponsor's willingness and ability to pay. Not just province of New Brunswick, but any employer that sponsors a pension plan. If there are debts that are due in the future, they depend on the conditions at that time as to whether the money will come in or not. Now, for a government, where does this extra money come from? From borrowing, if it can be done at reasonable rates, from increased taxes, or other expenditure cuts, or any combination of these three. That's where the money comes from, is there is a more deficit. Now, pension plans all over the world face similar challenges. The estimated shortfall in pension funding all over the world is measured in trillions of dollars. The biggest factor is the next one. Interest rates are very low. And as I said earlier, pensions are paid from contributions and investment income. If you don't have a lot of investment income, you need more contributions to pay the same pension because it has to add up. So when interest rates decline, the opportunity to make better returns going forward are affected. Aging of the population is another factor, although that one is manageable with a fund of sufficient size, but it does have implications. Because more money is paid out of the fund than coming in, you have to structure your investments that you have the cash to pay pensions every month. And investing too much in the stock market, if you have to sell at a low to pay pensions, you cannot recover that money later because it's gone. So, because you have to take less risk, it means that the investment return may suffer a little bit. And lastly, people live longer and that increases pension costs. Now, the premises under which defined benefit plans were developed 30 years ago, 40 years ago, the ones we have today in their current structure, are no longer valid. At that time, interest rates were higher, population was growing, younger, life expectancy was much less than it is today. So those premises that are the foundation of the plan as it is today are no longer valid. I think this quote from Jim Leach, the CEO of the Ontario Teachers Pension Plan, one of the best run plans in the world. I'll have to turn around to read it. The challenge facing many of us today, however, is how to accept the necessity for change before our backs are against the wall. Because given today's longevity and low growth, change is inevitable. The question is not whether to change or not to change, it's when and by how much. That's one of the best run pension plans in the world that has achieved very good investment returns. Status quo is not a valid option. Over the past 25 years, the province has routinely made its special payments to the plan. Le monde a changé. Beaucoup.
That's your job as an actuary.
Une sécurité complète du régime exige un montant en excédent de 5,5 millions. Les besoins financiers excèdent la capacité de payer. Management of uncertainty going forward is now the new reality. A balanced approach that is necessary to provide the best level of pension security within available means is what is is being looked at. Now, when shared risk plans were developed, there were many alternatives considered. The best practices around the world were examined. The solution that is being proposed balances the needs of members in terms of adequacy and security, and the needs of the employer to have predictable, stable, and affordable costs. The solution also balances the needs of all generations: new employee, mid-career, late career, and retired, and taxpayers. Several plans have already signed on the shared risk concept. Now, the proposal is not exactly any other structure in the world. It's been adapted to New Brunswick by selecting the best features of well-run pension models. It requires adequate funding and a strong basis for managing the uncertainty, and that allows for more security in the pension benefits. Now, you can't achieve this without some impacts, and that's where I'm turning to now. You can't achieve all of these objectives without having an impact on plan members. The first one I want to cover are active members. Les membres actifs, c'est ceux qui sont toujours au travail aujourd'hui. Pour eux, ce qui ne changera pas, c'est que les règles applicables à leur droit à une pension de retraite non réduite à l'âge de 60 ans ne changera pas pour le service rendu jusqu'à la date de conversion s'il y en avait un. Également, la rente aux survivants de 50% qui est prévue par le régime ne changerait pas. Les changements, c'est que les participants actifs vont devoir payer plus. En plus de ça, pour ceux qui sont plus jeunes surtout, ils vont prendre leur retraite plus tard s'ils veulent la même pension, parce que les règles d'âge de retraite vont changer, mais seulement pour le service futur. Les prestations qui étaient basées sur un salaire moyen de 5 ans sont changées à un régime de salaire carrière indexé. Les bonifications et l'indexation que les participants actifs auront sont les mêmes que ceux des retraités. Tout le monde sont traités égal. Il n'y a pas d'avantage aux actifs et de priorité aux actifs pour les excédents de la caisse. Tout le monde a la même priorité. Il y a un traitement uniforme de tous les employés. Il y a deux choses qui sont nouveaux pour les participants actifs. Premièrement, il y a des règlements qui sont clairs sur le financement. L'objectif, c'est d'établir des cotisations pour financer 115% de la valeur des pensions au début. Également, il y a une reconnaissance que dans des circonstances économiques difficiles on s'attend que ça va être très rare qu'il pourra avoir des réductions de pension. Now, for retirees, what stays the same? Your monthly pension at conversion doesn't change. Doesn't matter whether you're getting a survivor pension or a retiree pension. And for those who are retired who have a spouse, the 50% spousal benefit does not change. It's still there. It continues. The same thing the next day, and the month after, and the month after that. What changes is that the indexing would not be the same. It would not, you're used to an automatic increase on January 1 every year to the rate of inflation. That would not be automatic, it would be dependent on the performance of the fund. And that increase is the same for actives and retirees. Indexing could be higher because the 5% cap is removed, but it could also be lower. And I'll explain to you the chances of those things happening in a future slide. And what's new, as I said in French for the active members, there are explicit funding rules to increase benefit security. At inception, contributions are set to fund 115% of the liabilities or the value of the benefits, and there is explicit recognition of the possibility of benefit reduction, and I'll talk about that too in a couple of slides. And that would occur in very rare circumstances in very bad economic scenarios. There's also a change if it's converted to the governance of the plan. I talked about that earlier. A shared risk plan is created under a legal trust. Trustees that would be appointed representing likely retirees, active members from the bargaining, and so on, plus representatives of government, would be bound by strict rules that are established when the plan is created as to how to manage investments and management of uncertainty, the management of the funding, and the discipline that goes with it, and resolutions of conflicts. All of this would be overseen by the superintendent of pensions, who would have a right to intervene if the trustees didn't act in accordance with the documents that created the trust. Examples of plans that operate on that basis: the Ontario Teachers Plan, Ontario Municipal Employees Plan, the Nova Scotia Association of Health Organization, and the Nova Scotia Public Service Superannuation Act. We were asked to look at what would have happened in the last 20 years, because as you know, in the last 20 years we had the tech bubble burst, we had 9/11, we had 2008, and if the plan had been invested in a manner like a shared risk plan would have been invested, and if the contributions had been what we expect them to be, starting with what would have happened to your indexing in that period? Well, I must tell you that this is a very good period, that 20-year period for pension fund investing, because of the situation with interest rates. Even though there were bumps in the stock market, it still worked out to be a pretty good period, and indexing in that scenario would have been provided at the same level each and every year of the period. And at the end of that period, the plan would have been in excess of 150% funded, because the money stays in the fund and the contributions from the employer continue. Now, we know that this is but one. This is not the future. We don't know what the future is. The future is a whole realm of possibilities. And we developed simulations to look at the future in terms of potential economic scenarios. We did 2,000 of them, wide range from very bad to very good. And out of those scenarios, and the money would be invested in a manner similar to what the Brunswick Investment Management Corporation would still manage the assets on the transition. A little bit more conservative, but not a lot. Okay? Similar type. There's a 55% chance that the plan would earn 4% above inflation or more. That's the investment goal that the IMC has now for the current PSSA, and that we assume that the plan will earn it when we calculated that $6.2 billion figure that I showed you earlier. In that scenario, the shared risk plan would pay you your full pension, your full indexing, and the employer contributions would continue to build more reserves to protect the fund for the next downturn, because we know downturns occur in the markets. It would also be used to set up reserve to provide for indexing. Under the PSSA, same deal. Pension comes through full indexing, but the employer contributions would diminish. And if the surplus is large enough because of tax rules, the contributions from the employer would cease totally, and there would only be employee contributions going on. So the difference here is in the good times, the SRP builds reserve because it doesn't have the same level of automatic indexing, and you want to build the fund to provide it with a higher probability. Under the current plan, the employer stops contributing until the fund goes back to close to full funding, then regular contributions start. When the fund goes into a deficit, special payments start. That flow of money under the SRP is not trivial in terms of improving the benefit security of plan members. In that scenarios, or in the sum of those scenarios, the shared risk plan would provide your full pension and good indexing, not full indexing. About 76% of inflation on average. And this is important to you. And then there's what we call poor economic scenarios, where over the next 20 years, the investment performance is only 1.5 to 3% above inflation, much below the target of 4. In that scenario, the PSSA, the shared risk plan would provide your full pension again, plus 54% of CPI, not 100%. Now, under the PSSA, in order to support the plan in an economic scenario like that, contributions would need to go up to about 375, to 550 million. There's a difference on the French chart I just noticed. 375 to 550 is the extra, the total contribution that would be required compared to the 250 today. That's a big spread of money to improve the security of benefits in that scenario. And lastly, the law says that we have to be at least 2.5. We're modeling the PSSA to be at 2% or below. We want to be in excess of what the law requires in terms of the possibility of benefit reductions. The kind of scenarios that lead to these types of reductions, the best I can cover is the Great Depression in Canada, where the GDP dropped 40%, unemployment was 27%, and 20% of the population were on income assistance. In those scenarios, you would see benefit reductions. But under a shared risk plan, because we're starting at 115% funded, even if we were to slide into it, there would still be a little bit of indexing, 25% of CPI, but then there could be a benefit reduction of the order of 10 to 15%. Okay? Now, when the economy recovers, the first step that has to be done by the trustees is to reinstate the reduction in benefits to bring people back. And in those scenarios, about half of them do recover fairly shortly. Now, their contributions would also increase in the shared risk plan in that process. In those kinds of scenarios, the current PSSA is near bankruptcy. The funding level on a going concern basis would be less than 50%. And when you're in that space, on a going concern basis, drastic actions are required to recover. So that scenarios, yes, there can be reductions, but the PSSA is not necessarily in better shape in that space. And that's the distinction between the two. And on one, you rely on increased contributions from the province, and the other, the indexing is adjusted to make the revenue and the expenses balance. When you get down to the red area, they're both very difficult situations, but the shared risk plan, because it spent less money going in, would likely have, and almost certainly have, more money in the fund to cover your pensions. In summary, your pensions are not being de-indexed. The proposed plan design is to give indexing in the vast majority of years, and I need to explain, it's set up to give indexing from year 1, not from year 15. And I know that's come up in an earlier meeting. Because we aim to be 115%, there's money being paid to pay for the indexing each and every year. And that money is used to provide indexing now, as long as the assets have performed reasonably well. The goal under a shared risk plan is to earn more than 4.5% investment income in total, including the inflation, whereas the goal right now is 6.6. So it's a lower margin to exceed to develop excesses to pay that indexing. The survivor pensions are not being cut, but they're being treated the same as every other pension when it comes to indexing, and those very few rare scenarios, less than 2.5% chance, as I said, we're trying to bring that down to less than 2 by increasing the contributions a bit and managing the asset mix. We're working with INC on that. Your pensions would be more secure because there's more money staying in the fund, and contributions would continue even in the good years. And your pension will still compare favorably with other provincial public sector plans in Canada. So, that completes my remarks. Just a few final comments. Retirement security is critically important for every one of us. As a result, a retirement program based on hoping for the best to happen in the future should not be enough for you, should not be enough for government. We need to think the future future is unknown and will surprise us. We all know that. We need to think and plan for this future and be prepared for whatever comes. I hope that through my remarks you have a better understanding of the current status of your plan and what the shared risk option means for you as retirees. Thank you for your attention, and allow me to make this presentation. We are setting up some microphones, and the people at the head table and myself will be happy to respond to questions to the best of our abilities.